The e-commerce game has changed completely. I'll tell you why. As of today, venture investments are down 97% from their 2021 peak. Debt is up 195%, which means direct-to-consumer brands have two options: generate their own cash or die. And that means you cannot win as a marketer in 2024 unless you understand the financial realities of your business. We've seen countless brands lose because they set goals that weren't grounded in bottom line business results. Because somehow, in the process of building the infrastructure of scaling e-commerce businesses, the bridge between marketing and finance was left out. So we decided to build that bridge ourselves using a comprehensive framework for one, setting a core financial expectation of what is possible; two, mapping out how to accomplish it with clarity; and three, laying out milestones that let you know if you're on or off track. And now, for a limited time, we're going to build that exact infrastructure for free for three select brands doing between $10 and $100 million in e-commerce revenue this year. To apply and learn more, just click the link below and get started. This episode of the e-commerce playbook is brought to you by Parker, the financial stack designed to help e-commerce brands scale with a focus on profitability. Whether you're just starting out or scaling your store to 100 million, Parker offers a unique corporate card with limits up to 10 to 20x higher than traditional business cards, thanks to their performance-based underwriting. Plus, you'll get a true credit period on every swipe with rolling payback terms up to 90 days. Parker has already processed over $1 billion in transactions for hundreds of brands across apparel, luxury goods, wellness, beauty, food and beverage to help them scale. So join brands like Caraway, Oats Overnight, and Obvi, and visit parker.com today to get your application started. Hey folks, welcome to the e-commerce playbook podcast. I'm your host, Richard Gaffin, Director of Digital Strategy here at Commentary Collective. And I'm joined this week by our On the Front Lines war reporter, Luke Austin. Luke is, of course, our Director of Growth Strategy here at Commentary Collective. And he's back with some insights from a day-to-day life of digging into accounts and kind of seeing what's happening with our clients. So, Luke, what's going on, man?
We got a lot of people at the Meta Performance Marketing Summit this week. So I'm at home, not in the office, with no background noise, which is, I guess, kind of nice for the purpose of this. But yeah, that's sort of the big focus on our end. And I think in sort of a cynical way leads into this conversation we're going to have about Google losing share of wallet and some of the reasons we think that's happening. So
yeah. Exactly. Yeah, it's appropriate that everybody is away at Meta because that's kind of seems to be what's happening broadly on the platform. So a couple touch points here before we jump into it. We had the DTC Index recently released where we had some information about the share of wallet and Google losing share of wallet relative to Meta. And then also there's, I think Taylor tweeted yesterday, a couple of days ago, around maybe some specifics around how Google reps interact with brands. And then there's just some sort of interesting stuff to dig into about incrementality on both platforms. But anyway, the headline here is that overall, Google is losing share of wallet to Meta to the tune of, Meta has scaled from 75% to 80% of share of wallet. With other platforms losing, Google has gone from 20% to 16%, TikTok going from 5% to 4%. But of course, the big story here then being that loss on Google's part and the gain on Meta's. So, Luke, I know you have three very specific reasons why we think that this is happening. So we're going to dig into that, and then maybe we'll have a little conversation afterwards about, so what do we do? So let's kick it off with, or let's maybe start with your first point, which is, of course, around narrative and how that might be perpetuating this decline.
Yeah. So, and then to add some more context to this data point around share of wallet, this is from the DTC Index that we put out in tandem with some partners of ours. And what we're seeing is the share of wallet increasing on Meta, declining relative on Google. And then within those platforms, we've seen that the share of wallet within Google has increased towards Performance Max over time. And then on Meta, ASC, Advantage Plus Shopping campaigns, has increased to the newest ad products within those platforms are taking more of the share of wallet within those platforms specifically. But what we're seeing is Advantage Shopping, ASC is taking incremental share of wallet, and it's taking some of the money away from Google. That's where we're seeing this happen. Whereas Performance Max is taking up more of the Google share of wallet within that platform, but the overall share of wallet within Google is declining relative to Meta. So I think this is really important as we speak relative to the new ad products and the innovation happening within the two ad platforms, because I think that's the main thing that is leading to the decline in share of wallet within Google specifically. So the first reason that I think Google is losing share of wallet is because Google is losing share of wallet, and it connects to the narrative around what is happening on that platform and specifically what other people are doing on that platform. Within this space, specifically D2C e-commerce growth marketing, there are a lot of conversations that we all have with other brand owners, operators, marketers, with agencies, and with all of our clients are having those conversations at different times as well. And what we're seeing within, even outside of the sphere of D2C Twitter and what happens there in conversations between those folks is, as folks are pulling money away from Google and leaning more into Meta or other platforms, that perpetuates the cycle in a way where other folks start to lose confidence when they start to see the leaders at big brands that they look up to or other agencies that they respect, that is the trend that they are seeing. That perpetuates the cycle. And so I think even before we start to get to some of the technicalities and measurement and the ad products themselves, just the fact that this is the narrative and this seems to be what's happening in conversations with other agencies and brands perpetuates the cycle in a way that I think the narrative has a really strong impact on this outside of any specific technical impact itself.
Gotcha. Yeah, I mean, I think an important thing to point out that you pointed out before we hit record here was how few of our decisions are actually data driven. And I think part of that is illustrated here, which is that people are making a choice to pull back on Google just because they see everybody else making that choice, or see brands that they aspire to be or brands they respect doing that. So, but then let's maybe dig a little deeper to the reasons in the first place this may have happened. So let's jump to your second point here, which is around particularly how Google manages their platform and the relationship with people using it.
Yeah. So one thing that Meta does really well is every quarter there's initiatives around new testing opportunities that Meta puts out. Every brand gets access to some version of that list. We get a list from our agency partner rep of probably over 50 testing initiatives every quarter that Meta is putting out, net new test structures. And then we have access to a pool for the agency client, specifically around incremental coupon budget for conversion lift studies. But the key here is that Meta is putting out specific test recommendations based on new ad products or new additions to their ad product that they're putting out, or things that they're seeing across their data set that they're wanting more brands to test into to validate hypotheses on their end or help design their roadmap. And so Meta is putting together a list of testing initiatives of different ways to structure stories only and reels and ASC website only versus AFC website and shops, all of these specific test recommendations that are pretty easy to set up within Meta's experiments tool. And you get some ad credit incentive against these credits, 3-to-1 or 4-to-1, and then potentially an additional pool for engaging in conversion list studies on a quarterly basis. So Meta makes it really easy to engage in tests that align with their product roadmap as they develop it. And they come alongside brands and offering a coupon match to test into these, knowing that we talk about this in terms of creative and testing all the time. Like, there's going to be likely some trade-off in terms of short-term efficiency when you're engaging in a specific test, especially if it's a multi-cell test. And so they're recognizing that. They still want to push testing to these new initiatives, and so come alongside of brands in the coupons that they offer. In contrast, Google makes it really difficult, Google makes it difficult to have access to the clear measurement tools within their platform in the same sort of self-service way. And they don't have as clear recommendations as Meta does in terms of, here's our top 50 quarterly testing initiatives, and then here's the ad credit coupon match that we're going to put against them. It's much more difficult. And so what I think that does, connected to the narrative, is it can indicate that there's less innovation happening within that platform and potentially less confidence internally as well as externally around Google's ability to really deliver strong results and continue pushing incremental results to the platform if there's on a clear measurement, product development roadmap, and then they're not bringing those opportunities on a consistent basis to folks.
Yeah. So, I mean, it sounds like part of it is that Google does not encourage engagement with the platform maybe in the same way, in the sense that Meta gives people who are using Meta or whatever the opportunity, or really a very clear reason and a sort of a no risk reason to dig into new product innovations, of which it sounds like there are more. Whereas on the Google side, not only seem like there are fewer testing initiatives, or rather like product developments or something like that, there's actually less incentive or no incentive given to even engage with them, which then perpetuates the sense that there actually is no innovation happening on the platform. Does that sound accurate?
That's right. And I think the level of transparency as well also just leads to more skepticism when there's not clear results. And it's sort of the same narrative with that PMAX has had since inception, which is the black boxy nature of it, where you can't get reporting on the audience level, you can't get reporting on each of the different components of the asset group level. Like there's this level of lack of transparency that I think contributes to that. And one recent interaction that we observed is Google actually using third-party incrementality data point to support why we should be spending more into PMAX with branded terms, and specifically scaling up more into PMAX overall, allocating more budget to PMAX and specifically PMAX with branded terms included. And so it wasn't a test that they had done internally. It was a third-party test. I think that I don't expect that they were involved much in. More so, they just kind of found the resource and used it back up. And then the results of it were also misinterpreted, where it was, PMAX with branded terms was more incremental than PMAX excluding branded terms. But overall, a core takeaway of the test was that PMAX in general was over-reporting and less incremental. And so the brand that engaged in this test, brand we all know, has used that to inform their budget allocation and reporting from that platform. And so using the third-party signal, using a third-party measurement tool and then misinterpreting results also, I think, perpetuates the point that you just brought up, which is sort of like this lack of transparency or confidence in Google internally being able to make a case for why their product is really incremental at driving business growth outside of, hey, spend more within our core product, PMAX, and we'll add in some more granular reporting over time. Profit bidding, we know, is something that's coming down the pipeline, but I think it just leads to the perception that Meta is doing a lot more product innovation, is a lot more confident in the results of its platform because they have a testing roadmap that they align their recommendations with.
If you're tired of juggling spreadsheets to track your P&L and cash flow, or you're looking for a line of credit to scale your ads, it's time to try Parker. With Parker's integrated banking and analytics platform, you'll gain deeper insight into your business and how to grow profitably. Plus, their generous rolling payback terms on credit mean you can keep working capital in your business for up to 6 times longer. Parker is trusted by top e-commerce brands like Caraway, Oats Overnight, and Obvi to help them scale. Just go to getparker.com or click the link in the description below to get your application started today. So let's talk then about those results that one gets from Meta over and against Google, because that's essentially your last point, is that one works better than the other. So let's dig into that a little bit.
Yeah. So the third point here is what we consistently see across our data set and the brands that we run GeoLift, holdout tests, incrementality testing with, is that Meta is consistently higher incrementality than Google, and specifically we're talking more so Google PMAX. So higher than Google branded search, higher than Google PMAX, and substantially, not a small level of incrementality increase within social versus search. And so what we see using the third-party tools and measurement and how we partner with brands is social continues to contribute at a higher level of incrementality, whereas Performance Max is a lower level of incrementality. And we talked about incrementality. This word is getting used a lot more now, and specifically this year, than it ever has before. But really what you're looking at is isolating. Usually you're holding out a specific subset of geos. You can do a scale test as well, right? But in most cases, you're doing a holdout test within a specific number of geos, and then you're increasing or decreasing spend within a certain channel or tactic and looking at how those geos respond in terms of the overall business metric that you're measuring. It's usually total revenue or new customer revenue or new customers. And so in the reads that we've seen from incrementality studies is that social has a higher incrementality then it is usually taken into account for on a click basis, especially looking at a 1-day click. So if you see a 1.8 1-day click ROAS and your Meta platform, more so than not, we see that incrementality readouts will say that the actual contribution from Meta is at least as good, if not greater than that 1.8. Whereas on PMAX, the PMAX campaign is saying, I'm running at a 1.8, but the incrementality readout in more cases than not is saying that is below the level of reported by a significant amount. And it may be the 1.8 reported, but it's actually a 1.1 or a 1.2. And so we see this consistently, a large discrepancy in terms of incrementality versus paid social and paid search. And then what we see in terms of the business impact is that as we ramp up into Meta through a cost-controlled, specifically value-optimized structure that's oriented around net new offer angle and concepts, right? The whole thing that we always talk about. But as we scale up Meta through that framework, we see the impact on the business top line. Whereas engaging in scale tests on Google, we tend to just see maybe more conversion value reported in the dashboard, but lower efficiency and much less substantial impact on the business outcome through that channel.
Yeah. And just for the folks who don't know, including myself, what's geos?
Yeah, geography. So some subset of, usually it's some set of states or postal codes or areas. And so you'll really simply look at some percentage of the regions or geographies for a certain brand that contribute a meaningful amount of conversion volume to be able to isolate and use that as an indicative of the whole. So you'll say you're going to take out 17% of your total conversion volume from a subset of regions. That 17% based on the historical performance is really indicative of what the overall performance is going to be like. So you take those out, exclude them, and then you use that to assess scaling up or down on specific channels, and how those geographies respond is going to be indicative of how the whole responds. So,
gotcha. Okay, fascinating. Yeah, because my follow-up question was going to be, if Google's such a black box, how do you know that it's incrementally worse than Facebook is? But essentially, that sounds like it's the answer.
yes.
So let's then dig a little bit deeper into kind of maybe trying to understand some of the whys here. So if the point number 3 is that Google, or rather you see higher incrementality on Meta and not on Google, any ideas as to why that might be the case?
Yeah. So I think it's important to say that there is, for every brand, there's a level of spend within Google, within each of the main tactics: brand search, non-brand search, performance max, potentially display, YouTube demand gen, depending on the size of the brand. There is a level of spend that is going to be at the efficiency level needed. The question is, what should the right ROAS target be that you assess for that platform in terms of its effectiveness? And so incrementality tests will help to get to how much is the platform over underreporting the actual impact on the total business outcome, and then you can adjust your efficiency target up or down accordingly, and then allocate the budget. And so I think the core takeaway is most brands should still be spending on both, but what we're seeing in the share wallet is brands are spending less on Google, and that's what will happen when you get an incrementality read that's lower on that platform, an incrementality read that's higher on paid social. Great, we'll move some budget from Google to Meta because we can push more there, and actually the efficiency is lower on Google. So we are going to continue spending on both platforms. It's just going to be at a lower level on Google than we have historically, based on the incremental impact we're seeing from that channel. So the reasons why that are, I think that we talk about Meta and Google in terms of demand creation and demand capture. It's not that simple, but I think it's important just to understand where these platforms sit in the funnel and what the behavior is of folks within each of these platforms. And so it makes sense to me that Google would, that performance max, specifically, the shopping PLA and then your search within Google, it's an intent search driven platform, is going to have a lower incremental outcome than a platform like Meta, which is more generating demand and doesn't necessitate someone expressing interest in a certain keyword or brand term. So I think just in terms of where the platforms are positioned and how Google is search driven, they've tried to expand out of that, right, with Performance Max. That was one of the big things for them, is rolling it up and trying to create net new demand. What we're seeing though is that the ad inventory within Google Display, even within YouTube and Discovery, that's the demand generation channels within that platform that sort of start rolled up with shopping and search in the Performance Max product, and those placements are lower incrementality than a Meta. placement will be. And so I think that's part of it, just like where it sits in the funnel and that it's a search intent driven platform. And then outside of that, going back to our earlier conversation, the innovation within the product, I think would have been helpful. My perspective is that orienting the innovation around standard shopping, which became smart shopping, but rather than going in the direction of performance max, I think that's the direction we're headed. That's the direction a lot of other people are headed, is re-engaging with standard shopping, because that is the core placement and the core product in Google that really worked. And that's what we see work most. Even with performance max, a lot of folks were going to feed only asset groups to get to hack into shopping only placements. And so I think it's just a fact of trying to strip out some of the less incremental channels within the platform, get back to core search and shopping, and utilizing the standard shopping tool to get back there, since performance max just isn't shaken out to drive the same level of performance.
Yeah, which I think kind of leads into my next question, which is that, and I think I have some sense of the answer here, but if there's a fundamental difference in terms of funnel placement, let's say between Google and Facebook, or Google and Meta rather, why is it only now that Google is losing share of wallet vis-a-vis Meta? So, I mean, it sounds like part of the answer might well be that people have been taking PMAX out for a spin and are now realizing that it doesn't work in the way that they want it to, where it can't create incrementality in the way that it was attempting to maybe in the last couple of years. But can you think of any other reasons beyond that why this might be the time that people are finally realizing that?
So the stat we mentioned at the beginning in terms of the changes in share of wallet was in reference to 2024 as a whole. Sure. So it's been a trend that's been happening for over the course of this year. And even in the DTC Index, we have a graph in there that shows May 2023. And so over a year ago, we can kind of see like where this trend started. And you can see it's just been a slow, continuous dip. But then the start of this year started to dip even further. So I would say it's been a gradual sort of like Google has been feeling it gradually, and then Meta has been taking that share of wallet slowly over the course of the last 12 months. It's less, it's been more of a gradual change. I think when we see the inflection point of beginning of this year, and you can kind of see this on the chart in the DTC Index, but at the beginning of this year, you can start to see more of a drop within the channel. And I think, quite honestly, like part of that could be just the calendar year starting, brands reevaluating their budget distribution, engaging in new incrementality tests as well, and then having a little more leeway to take some broader swings, right? Rather than the end of the year around Q4, brands tend to not want to change up their media mix too substantially. But at the beginning of a new calendar year, there's more leeway to let's engage in some tests to inform our budget allocation, and then let's take some swings and really driving growth through the channels that are showing that strength, in particular Meta. So it's been more of a gradual decrease, and the inflection point around the beginning of this year, I think, just has to do with the timing of a new year starting and getting out of sort of the Q4 rush and being able to take a step back to approach the budget allocations.
Gotcha. All right. Well, that makes sense. So maybe let's leave the folks then with your thoughts on, given this scenario or given this reality, I suppose, what's the actionable takeaway there? Is there a so what to this that the folks listening at home can take to their own businesses?
Yep. So we've been having these conversations in depth on our end, and likely this will be a good follow-up potentially within the new tactics series. I don't know if we can plug that at this point, but on how we're changing our initial launch Google strategy at CTC in alignment with what we're seeing in terms of these data signals and what we want in terms of the platform's contribution. So on our end, we are making bigger shifts to starting accounts in more of a standard shopping oriented structure rather than a PMAX oriented structure. And we have a lot of specifics there in terms of brand terms exclusions, non-brand terms exclusions, how we're excluding existing customers with those campaigns. So we have a much more granular breakdown of what that structure look like. But at the core, it is standard shopping oriented rather than PMAX oriented, because we want to maximize delivery against the shopping channel. That is what we see consistently be the strongest performing, rather than having the ad inventory spread across display, discovery, YouTube within the same sort of campaign type. So much more standard shopping oriented, along with search and some of the demand gen layered in. But I think what we're seeing is PMax has increased the share wallet within that platform, but overall Google is losing the share wallet. And so that product itself, I think there's questions there. And it's worth adding, profit bidding beta is something that Google is rolling out, and they're making it available on the standard shopping side of things as well. So we're able to leverage some of Google's new tools that we care about within the standard shopping structure, which is helpful for us as well. So that's the bigger shift, and we can get a lot more granular in terms of what that structure looks like.
There you go.
Standard shopping.
All right. Well, more to come on that. But Luke, thank you as always for stopping by, sharing your insights. And to everyone listening out there, appreciate you listening. And if you want to check us out, you want to have more of a conversation with us around maybe how we can put this in place for your business, commonthreadco.com, click the Hire Us button, drop us a note about what you're looking for, what you're interested in, and we would love to talk. All right. That's all for us. Take care, everybody. We'll see you next week.